Good afternoon, everyone, and welcome to this online presentation of our October 2021 Economic and Fiscal Outlook. Thank you for joining us. I'm going to take you through the highlights from our latest forecast, and then we'll go into an online question and answer session. My slides and speaking notes will be available on the website at the end of this event, which you can also rewatch on YouTube. If you'd like to ask a question at any point, please use the Q&A feature, and Charlie, Andy, and I will try to answer as many as possible. Please give your name and institution. Let me start by thanking OBR staff and economists, public health experts, and other analysts across government whose expertise and hard work were once again essential to putting this forecast together. Though I should stress that all assumptions, analysis, and conclusions are our own. Our forecast closed to new economic data on the 24th of September and takes account of all policy measures up to and including those announced by the Chancellor today in his budget and spending review. We closed our pre-measures forecast earlier than usual to provide the Chancellor with a stable basis on which to complete the 2021 spending review negotiations, the first multi-year review in 6 years. And I'll say more about what taking on the latest economic and market data would imply for our forecasts at the end of my presentation. But let me start, as we have in all of our presentations over the last 18 months, with a summary of how developments related to the coronavirus pandemic have affected our forecast. This budget and spending review were prepared against a much improved epidemiological outlook from that which prevailed at the time of the last forecast back in March. Vaccines have now been rolled out to 79% of the target population, and public health restrictions have been lifted broadly in line with the government's roadmap, and now stand among the most permissive in Europe, as illustrated by the chart on the left. And as you can see from the chart on the right, while case numbers have risen over the summer and through the autumn, the vaccines have so far proven highly effective in breaking the link between infections, which currently stand around 3/4 of their peak at the turn of the year, and hospitalizations and deaths, which remain 1/5 and 1/10 of their respective peaks in January. In our latest forecast, we do expect a further increase in both COVID and other infections to lead to either a modest tightening of public health restrictions or greater voluntary social distancing over the winter. But we assume there's no return to a nationwide lockdown. Over the medium term, we assume the vaccine booster program and acquired immunity are sufficient to keep the virus in check, with minimal additional public health measures. However, there remain significant epidemiological risks to the economic outlook from either the emergence of vaccine-escaping variants or declining vaccine-conferred immunity, which could require the reimposition of more stringent public health measures while new vaccines are developed and rolled out. Turning to what this has meant for economic development since our last forecast, the first thing you'll note from a comparison between our March and October forecasts for GDP is that we overestimated the fall in output associated with the last lockdown. The latest data shows GDP fell by just 1.4% in the first quarter of this year, as opposed to the 3.8% we assumed back in March. This has been part of a pattern of underestimating the adaptability of the UK economy to pandemic conditions, which we explored in our fiscal risk report in July and informed our revised judgment in this EFO about the permanent scarring effect of the pandemic on output, which I'll come on to later. From this slightly higher starting level of output, the rollout of the vaccines and lifting of public health restrictions unleashed a surge in demand over the summer, which took output to only 1.1% below its pre-pandemic level by August. However, this strong rebound in demand created its own challenges, as it bumped up against domestic and international supply constraints in energy, product, and labor markets going into the autumn. These supply shortages and bottlenecks, which have been exacerbated in the UK's case by post-Brexit restrictions on trade and migration, are expected to act as a brake on the pace of recovery over the next 2 quarters, before easing by the middle of next year. Despite these near-term headwinds, output is still expected to grow by 6.5% this year and regain its pre-pandemic level by around the turn of the year, 2.5% faster and several months earlier than we forecast back in March, respectively. The combination of a stronger rebound in demand and constrained supply, both in the UK and around the world, has already pushed inflation above 3% in August, and we expect it to peak at 4.4% in the middle of next year, before it falls back to its 2% target over the medium term. But there's clearly a risk that inflation could rise by more than this and persist for longer. So in our EFO, we also present 2 scenarios in which inflation peaks 1 percentage point higher at 5.4% and takes 1 year longer to return to target than in our central forecast. And given the much greater inflation sensitivity of the government's debt stock in recent decades, we also show what this higher and more persistent inflation would mean for the public finance. One unambiguously positive effect of the stronger recovery since March has been its impact on the labour market. The rapid reopening of the retail, hospitality, and other sectors has drawn 3.2 million workers off furlough since March, leaving only 1.3 million on the scheme when it closed in September. And continued strong demand for workers, with a record 1.1 million vacancies advertised in the 3 months of September, has led us to assume only a modest uptick in unemployment to 5.25% this winter, 1.25 percentage points lower than the peak we expected in March. Looking out over the next 5 years, our medium-term forecasts since the start of the pandemic have been anchored by an assumption that it would lead to a 3% permanent reduction in the supply capacity of the UK economy relative to its pre-pandemic trajectory. Against this backdrop of a stronger recovery in output and employment, and drawing on the latest analysis and discussions with a range of outside experts, we've revised down this scarring assumption from 3 to 2% in our latest forecast. You can see from the chart on the left that this partly reflects the good news we've had about the resilience of the labour market, which has led us to reduce our estimates of the impact of the pandemic on future rates of unemployment and inactivity. But we still expect there to be 160,000 fewer people in the labour force over the medium term than we did in March 2020 due to lower net migration and a lower participation rate among the resident population. We've also revised down our estimate of the amount of investment lost as a result of the pandemic. The latest data shows that business investment's fallen by less than we originally thought, and we've revised up our forecast in the medium term as corporate balance sheets have also held up better than expected. However, this stronger picture on investment still leaves the total capital stock in the medium term 1.6% lower than compared with the forecast we did before the pandemic. And the changes in how and where economic activity takes place as a result of higher post-pandemic rates of remote working and online shopping may imply some writing down in the value of existing assets. For these reasons, we expect capital showering to account for around a third of the overall scarring. We've also revised down our estimate of the impact of the pandemic on total factor productivity to reflect the fact that corporate balance sheets, FDI, and investment in intangible assets have held up better than expected, while analysis of business surveys suggests more benefit from the closing of less productive firms. As you can see on the right, the downward revision in our overall scarring assumption from 3 to 2% puts us in the middle of the scarring estimates produced by other independent forecasters over the last few months, which run from 1 to 3%. We'll keep this judgment under review in future forecasts as new data comes in and we learn more about how the post-pandemic economy performs after the unprecedented government support it's received over the past 18 months is fully withdrawn. The downward revision to our estimate of scarring creates space for continued strong real growth in the next year, where GDP is expected to grow by 6%, before settling down to its trend rate of growth of around 1.75% by the end of the forecast. Higher real growth over the medium term, coupled with higher inflation in the near term, means that the level of nominal growth, nominal GDP, is 4.2% higher by 2025 than assumed in our last forecast, and broadly aligned with our pre-pandemic forecast in March 2020. The composition of this upward revision to growth in nominal GDP is particularly good news for the public finances, as we've also revised up the labour and consumption shares of that GDP. These upward revisions, along with the additional fiscal drag caused by the March budget's 5-year freeze in income tax thresholds, makes the additional GDP particularly tax-rich, given the high effective tax rates on labour, income, and consumption. So let me now turn to what the latest economic outlook, plus the policies announced in today's budget and spending review, imply for the public finances. Based on our latest forecast, borrowing still peaks at a post-war high of £320 billion, or 15.2% of GDP last fiscal year. This is £35 billion lower than we expected in March, due in large part to underspending by government departments, especially in the case of the NHS Test and Trace programme. Borrowing falls to £183 billion this year, £83 billion next year, and then to around £45 billion over the remainder of the 3-year forecast. And borrowing's lower in every year than in our March 2021 forecast, and even falls below our pre-pandemic March 2020 forecast in the middle of the decade. To illustrate what drives the change in borrowing relative to our last forecast, this chart breaks down that difference into first, changes arising from our improved economic forecast, shown in darker shades of blue and red, and second, changes arising from discretionary policy decisions taken by the Chancellor, shown in lighter shades of blue and red. You can see that our forecast changes improve the borrowing picture relative to March by around £35 billion a year over the spending review period, with higher growth and inflation pushing up receipts by around £50 billion a year, but also spending on welfare, debt, interest, and other items by around £15 billion a year. So on top of this £35 billion pre-measures windfall since March, the Chancellor's raised a further £15 billion a year in net tax increases, most notably in the form of the new health and social care levy announced in September. So with an additional £50 billion a year in additional revenue to deploy in this budget and spending review, the Chancellor spends around £30 billion of that, with half of it going directly from the new levy into the NHS and social care budget, and the other half undoing the cuts to departmental spending he penciled in since the start of the pandemic. He keeps the remaining £20 billion a year in extra revenue to reduce borrowing, which is given an additional boost of £5 billion a year over the spending review period by the stimulative effect of the net fiscal loosening announced in this budget. Looking in more detail at the tax side of the ledger, it's hard to understate how much revenue the Chancellor's raised over the past 12 months. The combination of corporate and personal tax rises announced in March, September, and in this budget means that this Chancellor's announced more tax rises this year than in any single year since Norman Lamont and Ken Clark's two 1993 budgets in the aftermath of Black Wednesday. And these tax rises, coupled with the fiscal drag assumed in our forecast, raise the overall tax burden from 33.5% of GDP pre-pandemic to above 36% of GDP at the forecast horizon, which would be the highest level since the tail end of Clement Attlee's government in the late 1950s, as shown on the left. The chart on the right looks in more detail at this 2.75% of GDP increase in the tax take, and shows that just under 1/3 comes from the fiscal drag in the tax system the Chancellor inherited when he took over the job in February of last year. Another 1/3 comes from cancelling the planned 2% corporation tax cut in the March 2020 budget, and the further increase in the main rate of CT from 19% to 25% announced in March of this year. Just under 1/5 comes from the freezing of personal tax allowances and thresholds, also announced in the March budget. And another 1/5 comes from the new health and social care levy announced in September. And other net tax increases are largely offset by a freeze in fuel duty and the lasting effects of the pandemic on some specific tax bases. Turning to the spending side of the ledger, the Chancellor uses 60% of the increase in revenues relative to our March forecast to permanently increase the size of the post-pandemic state in his 3-year spending review. So while public spending falls back from its peacetime high of 53% of GDP last year as pandemic support is withdrawn, it settles just below 42% of GDP in the final 3 years of the forecast. That's nearly 2% of GDP higher than before the pandemic, and takes the size of the state to its highest sustained level since the late 1970s, and before the privatizations of the 80s and 90s. However, the shape of this post-pandemic state reflects how much our society and world have changed in the intervening half-century. As you can see from the chart on the right, comparing the composition of spending in the late 1970s and the mid-2020s, by the end of the next spending review period, we'll be spending 60% more of our national income on the NHS, social care and pensions, reflecting the increase in the share of the population over 65, from 1 in 7 of us in the late 1970s to 1 in 5 of us by the middle of the next decade. 2 other budget items have made room for this increase in age-related spending. The first is defense spending, which has halved since the height of the Cold War, from 4% of GDP to the NATO minimum of 2%. The second is the cost of servicing our debt, which has also halved, despite the level of that debt more than doubling as a share of GDP since the late 1970s. One final item that bears further scrutiny is the level of investment in infrastructure, captured in the light grey bar. Unlike his predecessors, this Chancellor did not cut investment spending in response to the deterioration of the fiscal position in the wake of the pandemic. Instead, he maintained the large increases he announced in the March 2020 budget, which take total public investment up to its highest level for over 40 years. In this spending review, much of that increase in investment has gone on the government's stated priorities of improving regional transport links and addressing some of the economy-wide costs of getting to net zero carbon emissions by 2050. However, on the latter objective, one should bear in mind that the budget also freezes fuel duties and cuts air passenger duties for domestic flights, both of which are likely to increase rather than cut our carbon emissions. You can read more about how the policies announced in the government's net zero strategy and in this budget compare with our own estimates of the potential fiscal costs of getting to net zero in a box at the end of Chapter 3 of the EVA. The roughly £25 billion per year left after the Chancellor's completed his multi-year spending review is sufficient to stabilise the debt-to-GDP ratio at just below 100% of GDP. Debt peaks at 98% of GDP this year, and then begins to fall as a share of GDP over the next 5 years, both with and without the help of the winding down of the Bank of England's term funding scheme, though only just in the latter case. The eagle-eyed amongst you may notice that there's now a fourth line at the bottom of our chart of different balance sheet metrics. That's because in this EFA, we've produced our first ever forecast of public sector net worth, the most comprehensive measure of the public sector balance sheet, which rather than just focusing on debt, takes account of all the assets and liabilities in public hands. You can see from this deconstruction of net worth into its component assets and liabilities how much the government's balance sheet has expanded in recent years, first in the wake of the 2008 crisis, and again in the wake of the pandemic. You can also see how the composition of the balance sheet has changed over time, with the state taking on a growing stock of loans and equities on the asset side, first from banks, and now in startup companies, whose activities range from internet satellites to in-home spa treatments. And on the liabilities side, one can see the substitution of Bank of England reserves in exchange for gilts via the bank's QE operations, which has gradually reversed over the forecast period. You can learn more about how we constructed this forecast in a working paper published alongside this EFA. Turning to more conventional measures of the public finances, the Chancellor published alongside today's budget a new Charter of Budget Responsibility, setting out his fiscal rules for the remainder of the Parliament. The UK has effectively operated without a fiscal framework since the pandemic struck, but the Chancellor's repeatedly spoken of his desire to balance the current budget and get debt falling as a share of GDP once it was over. He's now codified those fiscal objectives as rolling targets over the next 3 years, alongside 2 caps on welfare and investment spending. This makes for an unprecedented 4 statutory targets of fiscal policy, all of which are met in our central forecast. The Charter also includes a wider set of indicators related to the affordability of debt and the health of the balance sheet, which it will take account of when making fiscal policy. And while the Chancellor is on track to meet his fiscal rules, he's left himself only the slimmest of margins against his headline target of getting debt falling by 2024, with just £17.5 billion, or 0.6% of GDP to spare. To put what might sound like a large amount of money in context, this is the second smallest margin that any Chancellor's ever had when setting a new set of fiscal rules, and all the previous ones were broken. It's 1/6 our average forecast error for the change in the debt to GDP ratio 3 years ahead, and it would be easily wiped out by 1% lower GDP growth or 1% higher interest rates in the target year. Now, both his headline targets are set over a rolling 3-year horizon, so the Chancellor always has the option of doing better next year. But with underlying debt trending down only slowly after the forecast period, and the balance of risks to both inflation and interest rates tilted toward the upside, we're likely to be in for another white-knuckle ride over the remainder of the Parliament. And as I mentioned in my presentation, there's been some interest in the fact that we closed our pre-measures forecast earlier than usual in this EFO. All operational forecasting, be it in public or private sectors, requires forecasters to trade off, on the one hand, providing decision makers who use their forecasts a stable basis on which to make those decisions, and on the other, taking on the very latest data, which might affect those forecasts, but also disrupt those decisions. My predecessor had previously extended Chancellor Osborne additional time between the closure of the pre-measures forecast and budget day to conduct the 2015 spending review negotiations, the last multi-year exercise. In this instance, because Chancellor Sunak was negotiating the first multi-year spending review in 6 years, and doing so in the aftermath of a pandemic, we judged it was in the public interest to give him more time than usual to agree the budgets of 23 government departments over the next 3 years. But we also committed, as we always do, if information came to light after we closed our forecast that we believe would materially alter our view of the economic and fiscal outlook, then we would illustrate its effect of that news on our forecast. In this case, there were several developments after we closed our pre-measures economy forecast on the 24th of September, including on the positive side, the upward revisions to the level of nominal GDP in the past, and to the pace of real GDP growth since the start of the pandemic in the quarterly national accounts. But on the negative side, rising energy prices, growing evidence of supply bottlenecks, and higher market expectations for interest rates as a result of those inflationary pressures. On balance, the information that came to light since we closed our forecast does not materially alter our assessment of near or medium-term economic prospects. In the near term, the higher starting point due to faster growth during the pandemic has been offset by increased evidence of supply bottlenecks and inflation headwinds over the past few months. We judge that together they put the level of real GDP at the beginning of next year back in line with our forecast. And in the medium term, news since we closed our forecast sheds no meaningful additional light in either direction on our scarring judgment, as it's largely reflected the strength of demand in the face of temporary supply constraints, rather than telling us something new about the underlying supply potential of the economy. Nevertheless, developments since our forecast closed would have a modest adverse would have modest adverse fiscal implications. As shown in the chart on the right, taking on market data from last Friday, the 22nd of October, would have only slightly reduced the margin the Chancellor has against his fiscal rules in 2024-25, knocking 3.6 billion off his 25.1 billion pounds worth of headroom against balancing the current budget, and consequently knocking 1.9 billion pounds off the 17.5 billion pounds of headroom in case of debt falling. But given the interest that some have taken in the timetable leading up to this forecast, we'll be taking the following 4 additional steps to provide assurance concerning the integrity, transparency, and objectivity of the forecast we produce. First, we provided a detailed account of the forecast process in the forward to the EFO document. Second, we'll be publishing the correspondence between the OBR and Treasury related to the timetable for this budget. Third, we'll be seeking public input into a review of the Memorandum of Understanding, which governs the forecast process and will govern the timetable for future EFOs. Fourth, we've asked the OBR's non-executive directors, Chris Kelly and Bronwyn Curtis, to conduct a review of the decision-making process around this forecast timetable for this budget. Their findings and recommendations will be published and provide a further input into the revisions to that MOU. We'd encourage anyone with views on how and where our forecasts should strike the balance between our equally important responsibilities of providing the government with a stable basis for fiscal policy decisions and providing Parliament and the public with an up-to-date understanding of the economic and fiscal implications of those decisions to share their thoughts with us as part of that review of the MOU. So in conclusion, the economy seems to have emerged from the worst of the pandemic bearing lighter scars than we initially feared. And that's due in no small part to the extraordinary support that's been given by fiscal policy over the last 18 months. On top of the proceeds from the stronger economic recovery, the Chancellor's raised taxes by more this year than any Chancellor since 1993. And even then it took 2 Chancellors, and taken the tax burden to its highest level since the early 1950s. He's used the bulk of this extra revenue to pay for a larger post-pandemic state, with new responsibilities in normal times for providing greater insurance against the growing cost of aging, narrowing the gap in life chances between different parts of the country, and helping the economy along the path to net zero by 2050. And this is to say nothing of the extraordinary support it's recently provided in times of crisis, and may be called upon to do so again in response to future shocks. There are those who've already questioned whether the tax burden will ever reach the levels presaged in our forecasts, and argue that taxes will be cut before they rise this high. It's not for us to opine on the desirability of this. But if this is indeed the case, then based on the forecast I've outlined today, it would merely raise 2 further questions for those who have to make fiscal policy. Which responsibilities that the state has now taken on would it then retreat from to accommodate these tax cuts? And if the answer is none, then would we be content to see our debt continue to rise in normal times, given what we now know about how much the next crisis might cost us? And finally, before turning to your questions, I thought it important to mention that this forecast marks Charlie Bean's last as a member of the OBR's Budget Responsibility Committee. Charlie is one of the best known and most respected macroeconomists in the country, with a 40-year career which has included spells as an advisor to the Treasury, Chief Economist and Deputy Governor of the Bank of England, Chair of the Economics Department at LSE, and President of the Royal Economic Society. We've been extraordinarily fortunate here at the OBR to have been a 5-year waypoint in his eventful journey in public service. His depth of expertise and experience has been especially valuable to us over the last 18 months in helping us to understand the implications of the coronavirus pandemic on our economic lives and prospects. Andy, the staff, and I will get our chance to say our goodbyes properly when Charlie steps down at the end of the year. But in the meantime, you'll get one last chance to ask him about our latest forecast. And on that bittersweet note, I'll ask Charlie and Andy to join me to take your questions. And the first question comes from Tim Wallace at The Telegraph. How significant is the rise in interest rates and inflation since your forecast closed? And what is the net effect once this is added to the increases in what happened before the window closed? Thanks a lot. Well, let me say a few things at the beginning, and then Charlie and Andy might want to add. I mean, there have been the news on interest rates has been on inflation has been actually broadly in line with our forecast. The 3.1 print on CPI. Interest rates have risen somewhat higher than in our pre-measures forecast, though we do anticipate, because there was a net fiscal loosening in this forecast, some monetary policy reaction, which pushes up kind of through our own internal modeling expectations for bank rate rises. So to some extent, the monetary policy response to the fiscal package in this budget is anticipated in our forecast, although it's still the case that that both expectations bank rate and the yield curve are above our pre-emergence forecast. And you saw, in terms of the fiscal consequences of those, they are relatively modest. They knock a few £billion off the Chancellor's headroom against meeting his fiscal rules, but don't for the moment get anywhere close to working it out. Charlie or Andy, anything to add on that?
I would just say on the economy forecast, of course, the reason that interest rates have risen is precisely because market participants expect inflation pressures to be higher. And the question is what inflation is compatible with output staying at the natural potential level of activity, and inflation pressures remaining subdued in the medium term. So one is to some extent offsetting the other in terms of its impact on the profile of GDP. So there's not a lot of news there for growth prospects. Richard made some remarks about the fiscal implications at the end of his presentation, but Andy may want to expand on them.
Well, just to say that, as we always advise, it really matters what drives inflation and interest rates as to the net fiscal consequences. So in this forecast, we've revised down borrowing because the economy is performing more strongly and there's a temporary burst of inflation. Isolating the effect of inflation and interest rates, they have added 14 billion to borrowing in the current year because index-linked, inflation-linked debt responds to inflation immediately. And they've added 3 to 4 billion to borrowing in the medium term as you have higher debt interest spending, but also higher returns on the government's assets. The news since then, as Richard said, is in the low single digits of billions of adverse effect for the public finances.
Thanks. Next question, Joel Hill's ITV. Why is the bank scarring assessment different to the OBRs? For two reasons. One is that the bank affects even less scarring of the labour market than we do, and in fact, no further increase in unemployment, which is not the case in our forecast. We see a small uptick in the near term, as well as slightly higher structural unemployment over the medium term, although, as I mentioned, we'd revise that down. But the other reason is that our pre-pandemic forecast for potential GDP was slightly more optimistic than the bank. So there was more of a gap to the post-pandemic position in any case, where the bank was a bit more pessimistic about long-run growth and potential output. So the counterfactual against which they're measuring is a bit lower than the counterfactual against which our scarring figure is measured. And once you take account of those two things, there's not much difference between us. But I don't know whether, Charlie, you wanted to add anything to that.
Yes, I think in terms of the components of scarring, we've also put a little bit more weight on impacts on the supply of labour, population and migration and so forth. But I would reinforce what Richard says, that you should really focus on the net of where we were pre-pandemic and the pandemic scarring assumptions. We had a more optimistic profile of the trajectory of GDP pre-pandemic, and it actually leaves the bank and ourselves in a very similar position now for the net effect. If you look at chart 2.37 in the document, you can see that very clearly, that in terms of where we're forecasting potential output to be 3 years out, they're very close to each other. And that's what really matters from the point of view of the medium-term outlook for the economy and the fiscal outlook and so forth.
Thanks, Charlie. Philip Inman from The Guardian. Why do you think the UK economy is unable to grow at more than 2% from 2023 onwards? Are you unable to include the impact of investment spending on the productive capacity of the economy? Well, to some extent, the fact that long-run growth is less than 2% over the longer term sort of reflects the scarring effect of the last crisis we faced, which was the financial crisis, and is all wrapped up in the productivity puzzle that macroeconomists around the world have been struggling with to understand why potential growth has been so much lower, and productivity in particular has been so much lower since the financial crisis. It's not the case that we never take account of increases in government investment spending on potential GDP, but typically small changes in government investment spending just don't make very much of a difference to the overall capital stock that the economy uses for production. The overall public sector capital stock is several times GDP, so small changes in 3% of GDP over the medium term does not make a very big difference to that overall stock. But in cases, including, for example, the Chancellor's big increase in investment spending back in the March 2020 budget, which took it from around 2 to around 3% of GDP over the long term, we did actually take account of that in the impact that it would have on growth. It's just, typically speaking, small changes in the amount the government invests from year to year doesn't make a huge difference in the overall stock of capital, which, if you think about in the UK, looking around, an awful lot of our capital stock dates back to the investment that the Victorians did a century ago, and all the cumulative investment done by governments since then. Not so much small additions and changes to transport schemes, water, sanitation, those sorts of things. Andy or Charlie, anything to add to that?
Well, I'll just add that obviously we take account of the impact on the private capital stock. We've done that in our scarring assumption, and a material change in the prospects for investment, potentially we would feed into our productivity assumptions. So there is, in principle, a linkage between our projections of potential output and what's happening to investment. But it's just because it takes a long time and a lot of investment to change the capital stock materially, it's relatively rare that that has a significant effect over the period of our forecast. This pandemic is one example of a case where it is big enough, but in many cases it won't be.
Great. Mike Larkin, how confident are you in the interest rate and inflation projections? Is this a best case or worst case projection? Well, all of our forecasts are a central case, but we do always make sure to highlight the risks around the outlook, and where we think that those risks are material and also worth illustrating their effects on the public finances, we do look at scenarios for different outlooks for things like inflation and interest rates, which obviously have big impacts on the public finances. And that was certainly the case this time around in the EFO. There are two boxes in this EFO, one looking at inflation scenarios and then one looking at the impact of those scenarios on the public finances. And maybe I can ask Charlie and Andy to describe each one of those.
Yeah, so as far as the first box, which is on the economy in particular, what we do is consider two scenarios with higher and more persistent inflation. So inflation peaks about a percentage point higher and takes a year longer to come down, but that is only because of a much more aggressive response by the Bank of England. So interest rates rise very much more than in our central case. They actually peak at something over 3% temporarily. So in the absence of that aggressive monetary action, inflation would peak about 3% higher than we have in our central forecast, and cumulative inflation over the whole of the period would be getting on for 8%. So this is a scenario with much more inflationary pressure underlying it. So we view it as a sort of stylized, almost a stress test, if you like. We wouldn't, it's not something we're predicting as a central forecast, but it's something that you at least ought to be cognizant might happen if there's more underlying inflationary pressures there. And what we then trace out is the consequences for real wages. The two scenarios, one corresponds to where there's more of the impetus coming from the product market, the other one where it's more coming from the labour market, and that has implications for the tax take, which Andy will now discuss for you.
Yes, so the two scenarios really illustrate how the source of inflation is very important for how it affects the public finances. The one that's driven by product markets and hits real wages leads to a spike in borrowing in the period of high inflation as the cost of inflation-linked debt rises, and then by the medium term, the effects just about net off, which is somewhat unusual. You would expect normally for the effect to be adverse throughout, but that's because of the freezes to all the income tax thresholds, which essentially means that relative to normal times, the public finances bear a little less of the pain, and taxpayers themselves bear a little more of the pain. In the scenario that's driven by wage inflation, that's positive for the public finances because the tax base is, particularly the income tax base, is supported by the nominal growth.
Great. Thanks, Andy and Charlie. Next question is from Anna Isaac from The Independent. How do you differentiate between Brexit's impact on productivity and the pandemics? Well, our forecasts do differentiate these respective impacts. And since the referendum in 2016, our forecasts have reflected a productivity loss from Brexit of around 4%, or potential output loss from Brexit of around 4%. And then when the pandemic came along, we've added to this a further loss in potential output of around 2%. So the fact that these shocks happened at different points in time meant that they were reflected in our forecast at different points. Obviously, Brexit is still happening, and it's happened. And the sort of Brexit we've had is more or less in line with what we expected, in that it has been essentially a plain vanilla trade agreement with the European Union, with not very significant offsetting effects from trade agreements with other countries. And so that's meant that we've left the 4% loss in potential output assumption over the medium term in our forecast. And then on top of that, we're understanding more and more the implications of the pandemic for our economy. We thought initially that it would have about a 3% loss of potential output. Our most recent revised estimate is 2%. We keep both under review, I should say. And in this EFO, we do an update on what the trade data is telling us about the impact of Brexit on our trade with the European Union and with the rest of the world. And so far, it's broadly consistent with what we would expect to see in terms of changing trade patterns from our departure from the EU, which is that imports and exports are down roughly about 10 to 15% since we left the EU. And also the trade intensity of UK output is starting to fall. So we're sort of less connected to the outside world than we used to, when we used to be before Brexit. And basically as a result of the fact that it's become harder to trade with our principal trading partner. So far, what we've seen so far from the effect of Brexit is consistent with the assumptions that have been reflected in our forecast since 2016. We've slightly revised down the scarring effect of the pandemic in light of what we've seen in the past year, but we will also keep that under review. Jack Barnett, do you think there's enough spare capacity in the labour market to avert a wage price spiral? And to what extent do you see inflation expectations trending to the upside over the next year? Charlie, do you want to?
Yes, that is indeed a very important question. We do think that there are signs of some parts of the labour market starting to overheat, shortages of HGV drivers and things like that. One of the key judgments that we've made is that the closure of the CJRS, the furlough scheme, will lead to some of the 1.3 million workers who were on furlough when it closed, no longer staying with their employer, but flowing into the pool of people looking for alternative forms of employment. So about a fifth of those people, and that will in the short term push unemployment up, but also it should over time relieve some of those labour market shortages. Now, of course, in some areas, you will need retraining, reskilling, in some cases, possibly even geographical relocation, insofar as jobs are in different parts of the country. So going forward, this is going to be something that obviously we, and I'm sure the Bank of England and other forecasters, will be monitoring pretty closely. In our central forecast, we think there's, broadly speaking, enough spare capacity to ensure there isn't a generalized wage price spiral, that it's really just shortages of specific occupations that's the problem. But one of the motivating factors for looking at the box with inflation scenarios is precisely that, because that judgment may be wrong, and there is some risk of a more general pressure in the labour market and a wage price spiral starting to gather force.
Thanks, Charlie. Next question is Paul Borsch-Bally. The report says you deviated from normal practice when taking market interest rates. Why and what did you take, and what difference would taking market interest rates have made? I think one thing to say is that we always close our forecasts in advance of budget day. And so to some extent, it is always out of date relative to the latest market data. And if there are big market moves or data arrives between when we close our forecast and budget, we do try and illustrate what effect that has. We're not able to run it through our entire forecast model because that basically takes time. We closed our forecast earlier than usual this time around for the reasons I explained, which is that the Chancellor was running a multi-year spending review. That's a longer process of negotiation and policy making than just making tax and spending policy for the year ahead. You're negotiating 3-year budgets for 23 different government departments. The same was done for George Osborne back in 2015. And the fact that this Chancellor was doing it in the wake of the pandemic meant that we thought it was important to give him a bit more stability than usual in this exceptional case. It is our plan to go back to sort of normal practice in future budgets when you're just doing an annual budget with a normal set of tax and spending policies, and may make exceptions again if there's a multi-year spending round. In terms of what effect it might have on the public finances, well, I tried to illustrate that in the last slide in my presentation, which we'll put on the website and we discuss in detail in the EFO itself. But maybe Andy, if you want to talk about the main dynamics of it and what different moving parts of the market affected what different bits of public finance.
Yeah, sure. So to let you in on a lot of the steps of the forecast process, when we closed the forecast, the market curve was much lower than it is today. The extent of the discretionary fiscal easing in the budget led us to assume that was lower than would be consistent with our forecast. So we moved the curve up. Since then, the markets themselves have moved beyond that. The simplest way of thinking about this is that when we closed the forecast, they were about 0.25% below the assumption we've used, and they're now about 0.25% higher than the assumption we've used. And because there is approaching £1 trillion worth of debt linked to short-term interest rates, 0.25 percentage point is worth £2 to £3 billion of additional spending. So those are the effects.
Great. Thanks, Andy. David Parsley, have you factored in council tax rises, and have your percentage figure for the average rise for households? I think this is probably definitely one for Andy, if he knows the answer, but if not, I'm sure the answer is buried somewhere in the blue book otherwise. But
these things are never buried when they relate to local authority financing. We do include the council tax rises. So these are the latest round of additional adult social care precepts. They raise our council tax forecast. They raise the local spending that is financed by them. They also affect our RPI inflation forecast. I'm afraid I don't have a figure for the average rise for households.
Thanks, Andy. James Beard, question from the modelling community. Out of curiosity, approximately how many individual inputs and variables feed into your forecast model? It is a lot, I think, is the short answer.
This might be one for me too.
But it might also be one for Andy to answer in detail.
So the economy model has about 600 variables, I think. The fiscal forecast is a disaggregated one, so it's produced. We impose assumptions on models that are used around government and compile them. The last time we counted, there were 350 models, let alone inputs into those models, which is why you'll see bags under our eyes today.
Thanks, Andy. Simon Neville at PA, last time we were all together, you were critical that the government failed to have any provision for longer term spending on recovering from COVID. Do you feel that's been addressed today? I guess let me address that question in aggregate, but Andy may want to go into some of the specifics. But we have highlighted in previous forecasts, as well as in our fiscal risks report, that one of the big risks to the outlook was the fact that the government had cut between 15 and 18 billion pounds out of the spending envelope in the wake of the pandemic over the medium term, and was essentially pretending that post-COVID pressures were going to disappear. What we've seen in this budget and this spending review is that essentially they've put that money back. Of the 30 billion pound increase in public spending that you saw being announced by the Chancellor today, about half of that is going directly from the taxes he's put up in the form of the health and social care levy to the health service, and basically the other half is just replacing the hole that he created in public spending just after the start of the pandemic to try and improve the medium-term fiscal position. So the money has been put back, but I think the longer answer is that it's been put back, but not very much more on top of that. Andy, anything to say about how, in terms of the specific risks we highlighted for health, education, and transport compared to what we've seen in the SR?
Yes, so this is a risk, obviously, we've flagged a couple of times. If you look at the profile of the additional resource spending review, its additions are higher in the near term than they are in the medium term, and that's partly funding the kind of catch up for public services, for the backlogs in health and the courts, and also the catch up spending in education, and keeping the trains running while passenger numbers are down. The figures in the spending review are broadly similar to the figures that we were looking at in the summer in the fiscal risks report. So from that perspective, this is a risk that has crystallized today.
Thanks, Andy. David Smith from the Sunday Times, you have weak growth in real wages and real household disposable incomes. Is that inflation or tax increases? So it is the case that we have recovery in nominal wages over the forecast period, but we also have above target inflation over the next few years, and also the fact that you've got taxes going up, and you've still got some net reduction in universal credit compared to what households have had before. The net effect of that is that real household disposable income per capita is not actually recovering to its pre-pandemic level until the second half of 2023. So you're seeing sort of stagnation in household disposable incomes over the next few years, and most of that is inflation. Some of it is tax and benefits, but the lion's share is the fact that inflation is eating away at nominal wages over the next few years, and then there's a smaller effect from the NICS rise as well as the fall away in use. We have a question from Anonymous. Many thanks for the presentation. It seems odd to model the impact of nominal GDP and then the impact of inflation, which presumably excludes the impact of inflation on GDP. Why don't you decompose the drivers into real GDP and all the impacts from inflation? We do produce a forecast for both real and nominal GDP. I think what's important to bear in mind for the tax system is that sometimes nominal GDP is more important than real GDP because that is what we tax. And in particular, over the next few years, when the personal allowances and thresholds in the tax system are frozen, as the Chancellor did in this last budget, that means that nominal growth is much better for the public finances than in other cases, because these indexes and thresholds don't change with the rising level of inflation. So that brings more people into tax as their nominal wages rise, but not necessarily their real wages rise, and also more people paying higher rates of tax. And despite whether their wages are going up because the real economy is better or because inflation is better. Another anonymous says to me, what are our views on the new fiscal rules, and in particular on the exclusion of the Bank of England and its relation to the OBR's new public sector balance sheet? I think officially our job is just to assess whether the government's meeting its fiscal rules, rather than to have any views on their merits or demerits. We are always in the game of providing more transparency, and that is one of the reasons why we produced a forecast of the government's balance sheet, and it does actually feature not in the headline rules of the charter, but in one of the indicators which government is going to monitor concerning the overall health of the public finances. When it comes to the exclusion of the Bank of England from the headline debt measure, in terms of how the government measures debt falling over time, I think you do have to give the Chancellor credit for the fact that in choosing this rule, he's actually making it harder for himself to meet it. It's actually very easy to meet a headline debt falling target, because when the Bank of England's term funding scheme unwinds, debt falls quite quickly, because the Bank of England is basically just unwinding a set of financial interventions it did in the wake of the financial crisis. It is much harder to meet the Chancellor's debt falling target when you exclude the effect of the Bank of England, because you're just left with ordinary tax and spending decisions of government, largely, and not other things. And that number is slightly falling from 2024-25 onwards, but not very much. It basically almost plateaus over the medium term, which sets up the challenges that I highlighted at the end of my presentation, which is that it doesn't give the Chancellor that much fiscal room for manoeuvre over the medium term when you've got debt excluding the Bank of England only gently falling over the forecast period. Madeleine Webb, does maintaining the public health grant in real terms translate into a real world reduction in the funding figure? Does anybody want to have a stab at that? None of us are health sector specialists, I should say.
I'm afraid it's not one I've looked at.
I think we'll have to pass that one on to our colleagues who are more knowledgeable about health matters than we are, I'm afraid. I think we've probably got time for one or two more questions. Adam Stone's recent news since the close of the forecast has had a £3.6 billion impact driven by interest rates and inflation, which of course linked. Please could you give some additional information on how sensitive the government's debt stock is to increases in inflation and the Bank of England base rate? And are we still in the malign scenario where inflation is driven by supply side scarring, i.e. low growth, central stagflation, or is inflation more driven by demand? In terms of what impact inflation has on the public finances and interest rate changes, it is the case that the public finances are much more sensitive to interest rate changes than has been in the past. This is through a number of different factors. One is we have, as Andy emphasized, we have a much higher share of our debt which is linked directly to inflation. It's index linked, inflation linked, which means that inflation feeds immediately into the cost of that debt because the interest rate just changes with the higher rate of inflation, rather than the government having to issue a new gilt in order to have to pay the extra interest. And also the fact that much of our debt has effectively been refinanced by the Bank of England, who bought up the government's long-term debt stock and replaced it with essentially floating rate central bank reserves, which means that much more of the interest rate on the government's net debt stock, including the Bank of England, changes much more quickly. And in fact, it's 6 times more sensitive in a given year to changes in interest rates than it used to be just a decade or so ago. In terms of what's driving inflation and how malign or benign is the scenario that we've seen so far, I mean, Charlie, maybe you can just recapitulate what you said earlier about what's been driving this inflation, and Andy could say something quickly about what it means for the public finance.
Yeah, before I do that, I would just draw Mr. Stone's attention to our fiscal risks report in the summer, which had a whole chapter on the impact of higher interest rates and higher inflation on the public finances, which goes into a lot of detail on that. And of course, it's still pretty much as relevant now as it was when we wrote it. Now, in terms of are we in the malign scenario or not, I'm not sure that's the way I would want to put it. The question is, are these temporary supply side bottlenecks which will resolve themselves and allow supply to rise up to meet where demand is currently, or is that an over optimistic view? Now, I think there's certainly some markets, particularly some of the international markets, when one might reasonably think that these are temporary. They may take a bit of time to unwind, so things like because containers are all in the wrong parts of the world, and that leads to problems at ports. That may take time to sort itself out. But in general, the private sector is quite good at trying to deal with these sorts of things. And certainly in our central view, it is the case that essentially the supply bottlenecks have largely eased by the middle of next year. A key question is whether there are still shortages in parts of the labour market, and that's something we talked about earlier on. Again, we think that the return of some workers who are presently out of the labour market and some of those who are on furlough looking for jobs will help to ease some of the labour market shortages, but that will clearly be something to focus on going forward. And if that doesn't happen, then you would be in a world where potentially demand is ahead of the supply capacity of the economy. And that would be consistent, of course, with significant scarring.
Thanks, Charlie. Andy, anything you want to add on the fiscal side?
Just a reminder that if you add a percentage point to interest rates and inflation, that pushes up debt interest spending by around about £23 billion. Bank rate is the most important, inflation next, and then long-term interest rates take a long time to feed through to higher spending.
And those numbers are comparable to the amount of headroom that the Chancellor has given himself against his fiscal rules, which is why I think we emphasise doing these kind of scenarios and thinking about these kind of risks when setting fiscal policy and making fiscal decisions. I think that takes us up to past, and we've gotten through a fair number of your questions. I'm sorry if we didn't get a chance to answer all of them. As always, you can submit them to us directly and we will respond as quickly as we can. But thank you very much indeed to everyone for their attention. Thank you to OBR staff, all the work on yet another excellent forecast. Thank you in particular to Charlie for his last ever forecast. And we look forward to seeing you all again when we do this again early next year. Thank you very much.